Nice catch, Gabor. Awesome. So let's dive deep into order flow and everything that concerns, you know, uh, market mechanics as a whole. And I have a little line here, some bullet points that I'm going to go through to help me out with having a clear structure for the session. So I will start with a review of market mechanics because I think that's crucial even to understand the whole strategy of TTT as a whole. Because as we've understood, the whole TTT methodology is based around auction market theory. You've seen this also with Fabio in the first session he did, and auction market theory summarizes the reality of market movements, and market movements are nothing else than the result of decisions of huge operators. Okay, so when we open a trade, it's pretty fucking easy to get filled. When a bank or an institution or a fund or a hedge fund or a pension fund or a sovereign fund or all the other huge market participants have to put a order inside of the market, it's not as easy as clicking buy or sell. They need to fraction those orders into multiple small orders and gradually put them in the market. It's not something as immediate. Okay, so the whole thing of liquidity, the whole problem with liquidity is if you're a big guy and you put all the orders in the market all at once, you're going to move price very, you know, with a huge impact. And that's not so good because, for example, if, the order book explains this pretty easily. Let's just make a very easy example where there's like 100 order in the ask, which is, as we remember, sell limits. So this is the passive counterpart, okay? And you're, for example, a pension fund that you're trying to put 100 billion or I don't know, $1 billion in the markets in the future market of, I don't know, S&P 500. I'm just saying something pretty random. And you have 5,000 buy orders to put in. Okay. So buy now market 5,000. If you buy market, you're going to buy at the best price. And the best price is the best ask because these are the sellers in the book, and the sellers in the book will act as your counterpart. So these are the so-called market maker orders. Okay. So if you want to buy 5,000, you're going to need to fill 100 here, 100 here, 100 here, 100 here, 100 here, 100 here, 100 here. And only with these orders, we filled 800 contracts. Okay. 800, by the way, 100 is around the average size you see in the book of the S&P 500 ES E-mini contract. So if you need to buy 5,000 of that, which is not a huge amount for a big market participant, and you place it in the market and buy it now all at once with one single order, you would move price enormously. And instead of having the 5,000 filled at this price, for example, you're going to have to adapt and accept to get worse and worse fill to your order. And that's crucial to understand because this dynamic of order filling is the basic of order flow and why the TTT strategy works and has a clear edge because it's based on the reality of market movements, on what's happening behind the scenes. So this law of the market, why I am so, let's say, presumptuous to define it as a law of the market, even though it's not a law because, laws are made to not be respected in a way. And there's many exceptions. But why this is a great rule and a great basis that have a concrete and base on reality on the reality of financial markets, unlike some other 3D methodologies I've seen throughout the years, because I've seen them all. I've seen technical analysis, I've seen the basic trend line strategies or the breakout strategies, or even oscillators like indicators like MACD, like RSI, like Bollinger Bands. And the problem with these is that they're just based on past price. So your only reference is what happened before. And you're trying to build some sort of pattern recognition type of model, which is purely based on patterns and not based on meaning and reality. So you clearly start to understand, when you understand how a basic thing like filling order works, that when there's a market that goes sideways and is not moving particularly fast, this means efficient order filling for big market participants. Because what happens in these phases of the market is that there's, let's say, an overall equal force between aggressive sellers, aggressive buyers, passive buyers, and passive sellers. Which means big market participants, which are the people who rule the market and ultimately drives the market, because markets are moved by big market participants, they agree here that exchanging contracts at this level is good, is fair. They both agree. There's an agreement in the market. But at some point, something might happen. And as we've discussed, price rises. And I have a question for you. Why is it rising? Can you try and give me a simple answer, one sentence maximum, a couple words, on why market is rising? Inigo says lack of sellers. Lucas says aggressive buyers. Eduardo says because someone wants to buy. Gabor said the exact answer. Price discovery, yes. Okay, so they're all partially true. But what's actually happening is that they are trying to find a fill to their massive orders. It can be one market participant, it can be more, usually it's more. There might be retails in it, there might be algorithms in it, and it's much more complex than one single operator. But for the simplicity of this explanation and for the sake of this lesson, let's imagine it like Wyckoff did. This guy moving the market being the so-called composite operator. So the totality of market participants. And what they're trying to do here is to fill their buy orders. Because something changed in the perception of future value of this specific underlying contract, of this specific underlying asset of this contract, that changed the perception, and they, triggered the need from all of the composite operator to want more and to accept to get filled at worse and worse prices as long as they can get filled. So the ultimate reason for when price is steady and when price is exiting fair value and getting into a state of imbalance from a phase of balance is searching for liquidity, is searching for a counterpart, searching for a fill. And when price moves, there's sometimes these very participated moves, very long moves, very wide market waves that sometime happen in the market. And that's because these market participants can't buy efficiently anymore. They can't fill efficiently and have, the average price for their position at this level, but they are ready to accept worse and worse prices. And who is us to say that buying here is wrong? Some people try to catch the lows, for example. Well, that's a very understandable way of trading, and you can trade like this. We've seen some of the example of Patrick Nill. He's mostly a counter trader, but if we only have to think this rationally, we would say the move has started already. I'm not going to jump on a move. Well, there is someone who is. And who are these participants? They can be short-term speculators, so they might get in, get a couple ticks, and then close it. But what happens is that they will keep buying, and most likely there will be another situation like this. Another situation where price gets into balance again, which means in this area, there is still market aggressive buyers, the same guys that were buying in this phase, they are still buying here. Otherwise, price will fall. But what changed here is that they have found liquidity. They have found enough sell counterpart to fill their trade at a reasonable price consistently. And this, my friends, is the definition of acceptance. The definition of acceptance is we are accepting to keep trading, because here trading activity does not stop. Actually, here, as you've remembered from the volume profile, is where the trading activity is at its peak, pretending that this is a volume profile. So acceptance means we're accepting to keep buying at these prices, and the counterpart is saying we're accepting to sell at these prices. So if we accepted this to be the fair value to exchange contracts and fill our orders for our idea 5 minutes ago, or a day ago, or a month ago, now this is the fair price that we both accept. If some part of the market is going to say, hey, you know what, this is not really fair for me to keep buying or keep selling at these prices, that's when price will move. So when price moves is both, is aggressive buyers, for example, not finding the liquidity, and sellers saying, you know what, like these prices are okay to sell, but not so much. But when we get here, yes. So it's a constant balance between buyers and sellers, aggressive in the aggressive form or in the passive form, agreeing or disagreeing on what's the fair price for now. Is that clear? Send 8 in the chat if everything is clear. Awesome. So how does this translate? We know how this translates in price, because the whole TTT method is based on what's happening in these ranges. Because with a P shape, for example, okay, we have, for example, just as a recap, 2 lower closes, then 2 upper closes, then 2 more closes down, and the range starts evolving. And so we qualify the range with the closing here and with the closing here. Okay. What this is, and what is the genius thing about what the work of Tom and Serge has been, is being able to rationalize this and having an objective way of defining ranges. So this is our range. And one of the first patterns you've learned is the breakout, right? So the breakout is price. It's a clear signal that market participants, that some part of the market participants, are willing to accept to pay worse prices to get filled, and they're looking for the next area of liquidity. That's why they simplified market movement in such a way as ascending P shapes or descending B shapes. That's why the first pattern you've learned is the breakout. But sometimes this doesn't always, end up good. Sometimes this attempt of finding new liquidity is counteracted, it's front run by aggressive sellers, which they were agreeing here that prices were good enough to sell. So if price go above here, they might be even more convinced because these are even better prices. So they keep selling even more aggressively. We get back into the range, and that's our second pattern. We go to the other side. Say we go to the other side.
Here are matches for the other side.
Okay, Siri, thank you very much, but we were not asking for your opinion. The same thing can happen here. Price tries to get lower and then closes back inside. This is the so-called break-in. And in the order flow space, we call these phases failed auctions. Because if you know what an auction is when there's Picasso's paintings or Leonardo da Vinci's paintings at sale, and there's an auctioneer with a hammer, and then there's all these buyers raising the number and say, hey, I wish to pay more, I wish to pay more, I wish to pay more, I wish to pay more. That's exactly the mechanism of markets. That's why it's called auction market theory. And that's why this is called a failed auction, because buyers were ready to pay for Picasso's painting at higher and higher prices. So the price of the asset and of Da Vinci's painting raised during the auction, because there's the offer which is being made, there's a new price, and that new price has been bidded by the market, by the participants at the auction. So back to our dear friend order book. Oh, I don't know what happened. I think we were here. No, I think we were here. Yes. So back to our order book. This is our order book, okay? And how markets work, as you've probably started understanding, whether from my videos or from this course, this is the bid, and here we have buy limits. And how the auction unfolds is with both buy contracts and sell contracts. So there's not just something being sold. What's being sold is orders, whether they're buy or sell. That's why we can say that the supply and the demand is not supply is sell orders and demand is buy orders. We could say that there's a supply of orders, which is buy limits, and sell limits, which are the so-called market makers. And there's a demand for orders, which is market buy it and market sells. These are the so-called market takers. So in our auction of orders, market takers are the demand, market makers are the supply. These are Da Vinci's paintings, and these are the very rich guys who are wishing to pay more to buy the Mona Lisa. Okay? The market makers translate into the order book. Okay? So the order book is a clear representation of the current state of the supply of orders in the market. So for example, there might be 100, 100, 100, 100. These are the contracts at each different price level. So as you know, future moves in ticks. So each price, each level of the price ladder of this staircase of price is a tick. And for every tick, we have a certain amount of volume of buy limits and sell limits. So let's say this is the last price. This is the current price, let's say, okay? Let's give it a color. Okay. Which means this is the last tick where at least one contract was executed, was traded, okay? So we don't have a way to see aggressive participants before they buy or sell something. But let's imagine them as little traders from their trading floor ready to click the buy market or sell market button, okay? What they will do is, for example, this participant needs to sell now. So I need to sell market now at the best price, for example, 75 contracts. Okay. If he needs to sell it, market now, who is he going to sell it to? These guys. That's the best price at which he can sell. Because if I want to sell those 75, there needs to be someone buying those 75s. So in the bid, 100 guys with one contract or one guy with 100 contracts. Anyway, 100 contracts are placed there as goods in the auction. There are Mona Lisas that say, hey, here it is. If you wish to pay for it, if you wish to sell this, to be a counterpart to this order, this is the price. You do you. So they say, okay, I'm going to get 75 of that. Perfect. Oh, fuck. I have to stop pressing the space bar. Okay. So these 75 contracts are matched with those with 75 of those 100 contracts. So these will become 25. Okay. And 75 of those contracts were matched with these. And these orders goes right into our footprint. Let me just recreate it real quick. Perfect. So we were 100, 75s were bought, and they go right here in the footprint, in the bid column. Here we have the ask column. And automatically our footprints put a 0 here because we have this level. Then another guy comes and says, hey, you know what? I need to actually buy at the best price, market, 325 contracts. So what's going to happen? 325. We have 100 only here. So he's going to take those. Okay, that's good enough. 100 will be taken from here. One more 100 will be taken from here. And 25 will be taken from these guys. So as you can see, his order has been fractioned into different levels. So those hundreds are executed. They go in the footprint. These 100 also are executed. They go in the footprint. And these guys are executed and also go in the footprint. For these 100, 25 are executed because 325. And only 75 remains. In the meantime, here, there is 0 contracts. Because that part of the book has been, as we say, swept. So it's been cleaned up. They have emptied the book with a single order. So now, if I want to sell, the best price is still this. This is what we call the best bid. And this is what we call the best ask. So when anyone now tries to buy anything or sell anything, there's a gap between the best price to buy and the best price to sell. This gap is called spread. Do you see how bit by bit we're understanding everything about market mechanics and about how spread works? And this is to really understand how market moves. And this is the basics. Then there's a lot more to learn, but we will get through it bit by bit. So now, for example, like usually in normal markets, in very liquid markets like S&P, the book will repopulate pretty quickly. So you will start having, I don't know, maybe 25 here, 25 here, 25 here. So the spread is lower. And you have the so-called raw spread, like market spread. This is the basic market spread. So this is how it works, you know, conceptually. But, well, is everything clear for now? Please another 8 in the chat if everything is clear. Okay, awesome. So what actually happens is the people that are placing orders here and here, there are some people who are professionally placing orders there. And this is the market maker business model. So the market makers are people who, like big institution, big participants, which are acting as liquidity providers. Okay, so they provide liquidity to the market. Why? Why would they do it? Can you guess what the business model is? Let's see if someone can guess it. In the meantime, I'll grab a glass of water because my throat is getting dry. Correct. They're making money with the spread. And with as little as a 1-point spread, they earn money because, for example, let's say this is 100 and this is 101 price. Sorry, 100 here and 101 here. And let's say for each contract, I earn $1. The market maker business model is I'm selling here in the ask, and I'm buying here in the bid. So I provide liquidity to whoever is willing to pay a worse price to get filled, so market orders. And every time someone buys from me, and then someone sells to me, I've made $1 for every contract. Because I sell at 1 all the time, and I sell at 101 all the time, and I buy at 100 all the time. So what they're doing is they're earning from this thing, from people buying and selling market the whole time. So if price starts going higher and higher and higher and higher, they are kind of losing money because they're selling at 101, they're selling again at 102, 103, 104, 105. So what market makers really don't like is directional markets. So what happens when an initiative phase, a search for liquidity starts, is that it's being exacerbated by market makers pulling their ass out. So market makers are not so incentivized of having a big exposure to the markets when prices are moving really fast. When is the moment where markets are moving at the fastest? This is a question for you guys. After new releases, correct. And guess what happens during news releases? Let's see the book in one of our latest CPIs. This is slightly before. This is a heat map software that we will provide also with deep charts. It's similar to Bookmap, but it's much easier on the software side. Like it's less committing for the hardware, and it's much more easy to use, I think. So there is some contracts. This is the bid, this is the ask. And this is what happens right before the news. See, it's 16:29, which is 9:30 or 8:30 market time. And as you can see, the book starts being completely empty. So many levels are completely empty. That's why there's a big spread during news, because market makers, professional market makers, especially lead market makers, which now we'll understand, are allowed to, take their orders out of the market, get their ass covered, and not provide liquidity to a market which is constantly moving really fast. So that's what happens. Empty, completely empty book. And then the first orders are executed where? At the first level where there's any liquidity. So you see price moving really fast from one place to the other. And normal people that don't know market dynamics says, hey, there must be a huge volume. No, there's actually very low volume. There's very low liquidity, actually. And then as you see, some moments after, 3 seconds after, liquidity starts slowly to being put back in the market. Let's see one of the last NFPs. We have a book here. We have a book which is pretty full. And right before 15:29:59, it's completely empty. Look at this. Sorry, just a second. Okay. And orders are being executed and scattered all over the place wherever there is any liquidity. And then things go back to normal. This is another example in October's NFPs, same thing. Emptying the book. Look at this. There is literally zero liquidity except some algorithms or some other market participant, which is not a market maker by profession, who are just willing to buy those level. Okay. And then afterwards, this happens. Just a second. Is that clear? I hope yes. So it's important to understand also market makers in this. And another thing which is important to understand, and we're getting deeper now into market mechanics, is how does the queue of these orders work? Because there's a queue, it's not just one person placing 100 contracts. It may be 100 person placing one contract. So let's say this is the best ask and this is the best bid. And let's say there's 100 contracts. There's two methods of how, for example, if you're a company, if you're a factory, and you're selling, I don't know, stuff. Let's say this is a pack of apples, for example. There's two ways you can manage the storage. One is the LIFO, one is the FIFO. LIFO stands for last in, first out. So, okay, apples are ready, I'm putting them in the storage. Okay, more apples are ready, okay, I'm putting them in the storage. Okay, more apples are ready, I'm putting it in storage. Okay. But which one okay, someone comes and wants apples. Okay, I take the last thing I put inside. I'm selling this. And then this, okay? So they go inside and the last to be placed in is the first to go out. Last in, first out. With FIFO instead, which makes more sense, the first pack of apples that I produced is the first one I'm going to be selling. Then, I don't know, more apples. So the first buyers will get the first one I've put in. And then the second one. So markets, if you go, for example, in the CME website, let's see if we can go real quick. CME. Matching algorithms. You can easily go by yourself in the CME website, and you will see that most of the matching algorithm works with FIFO, FIFO.
FIFO stands for first in, first out. As the name implies, FIFO allocates by best price and earliest time on the 100 arrives.
Yeah, so you can look at the explanation. It's exactly the same I've explained. As you can see, some are just FIFO. Some are FIFO with lead market makers.
Lead market maker, LMM, is a designation given to CME Group authorized market makers who provide a two-sided market for an assigned instrument and therefore receives a percentage allocation of incoming orders.
Okay, they receive a percentage allocation of all incoming orders. So in some markets, which are then listed into the CME, there are some market participants who, by right, they get 40% of incoming aggressive volume, for example, 40%. So part of the book is first in, first out. Part of it is reserved to a lead market maker, which gets most of the contracts. But let's simplify and just say it's a FIFO model. It will mean that if there's a total of 100 orders here, 50s, for example, are this one. Then there's another, I don't know, 20 here, and so on and so forth until we reach a total of 100. So if a buyer comes in, the first orders to be filled are going to be the first one that has been put inside of the book. Okay? So these will be the first to be executed, and then we will execute these ones. Is this clear? Please an 8 in the chat, because this is going to be crucial to understand icebergs and spoofing. Okay, so there's a priority. In the line of the book, there's a priority. And if you didn't quite understand, please feel free to ask questions at the end or rewatch this, because this is, I can understand this can be a lot of stuff, but I'm trying my best to explain it to you in a very simple way. So the first two patterns that we're going to try to understand is icebergs and spoofings, which is a pattern that Serge, which is the scalper of the team, actually trades. Okay. Let's build our book again. Let's make it simpler this time so we don't have to draw. I'm sorry, I have this like occupational hazard, and I always draw on TradingView for some reason. So let's have our book here. Pretend this is our book. And let's have our footprint here. Okay. Then we're going to see practical example of this happening. So, let's say there's, I don't know, 50 contracts, 20 contracts, or 50 contracts and 20 contracts like this. Okay, so what spoofing is fake orders, or like, let's say real orders, actual orders that are being put inside of the book, which are a ridiculous quantity, abnormal quantity, 1,000, okay? 1,000 contracts here. And, you know, when you're looking at the order book and you see 1,000 contracts, you're going to say, yo, today we might be want to selling. There's a big guy who probably knows more than me who is trying to sell the market. So it's better if I sell as well. And so you start selling. You sell at the best bid, right? So say you execute 10 contracts there. Or let's say 20, and you empty the book. Then something happens. These 20 disappear because you just sold them. But in a matter of a millisecond, they reappear again. I say, okay, well, let's keep selling. There's 1,000 contracts, people selling. Let's keep selling, you know? This is what the market might think. So we keep selling. So 20 more contracts are being sold. They disappear. And then they reappear again. You start seeing the patterns. By the way, we're seeing this very slowly, but this happens in milliseconds. This happens very quickly. We're talking about scalping. We're talking about very short-term order flow. And there's opportunities to capitalize on what we're going to see and also have a solution to not being, you know, staying in front of the charts all the time and wait for these patterns to happen. But we have some indicators that we will give to you for free in the next few months that will allow you to identify these things by yourself, like without any, you know, with a notification. Anyway, this keeps happening and it keeps happening, and you see a bunch of orders accumulating here, maybe up to 1,000 orders accumulating here. So what's happening here, actually, in the background, and you start realizing it, is someone is constantly reloading the quantity of contracts that are in this bid because they don't want to be seen. So, just like an iceberg, they only show the tip. Just the tip. Just the tip, baby, please. Okay. And that's why they call it iceberg, because if this is the water surface, you only see the top, but actually the big part is underneath, you know? So that's what happens. An iceberg order is an order which is trying to be hidden, and it's basically an algorithm that refills the book as soon as these contracts are being executed by the market. So what happens most often is that these 1,000 orders will disappear. It was all fake. It was all a perception. It was all a manipulation of order flow perception to make people think that they should sell, while actually, most likely the same guy who was faking these 1,000 orders actually wanted to buy the whole time. So he manages to buy because he manipulated the perception to the whole market that there was a big participant trying to sell while he was actually trying to buy. That's why it's illegal. So spoofing is illegal. If you see spoofing, report it to the CME. Don't worry. I'm just joking clearly, but it still happens in some markets, okay? I'm not a huge spoofing trader, but I'm a huge iceberg fan for sure. Because independently of the spoof, if there's an iceberg, then it's real. Okay, because there's someone actually being executed. So someone might ask, well, doesn't he risk that someone will buy and execute those 1,000 contracts, but he actually wants to buy it and he doesn't want to sell? Those are fake orders. So what like, isn't he risking something? And that's where our FIFO comes in. Because as I told you, in a chronological way, this guy, let's say maybe there's like 20 contracts in the front of the queue. And then he puts his 1,000 contract here. If these guys gets executed, now it's up to him. But probably he will have other people in the queue. So what he will do is he will delete these 1,000 orders in a matter of a millisecond and replace them. So he's going to cancel it and replace it, cancel it and replace it. So he makes sure that he's always at the back of the queue and he never gets his order actually filled. Do you understand how crazy this is? The first time I understood it, I was like, wow, I haven't known anything about this shit for years. And this is crucial information to understand what's happening in the short term for a scalper. I don't understand why a short-term scalper who scalps in the 15-second time frame is not using order flow. You're losing so much information that you don't know about, which is crazy. So, how does it work in the iceberg side of things, this FIFO thing? There is two types of iceberg orders. We have native icebergs and synthetic iceberg. Synthetic icebergs, which is a very simple difference. Native icebergs are provided by the exchange. So you, as, I don't know, JP Morgan, I'm just saying, tell to the exchange, you know, I want an iceberg. You create it for me. Okay, JP Morgan, I'll create this iceberg for you. So exchange. And then the synthetic iceberg are created automatically by the broker or the firm. and they basically recreate it. And there's some advantages and disadvantages, which is very useful to know if you're trading icebergs. If you go in the CME website again, which is an amazing source of information, if you only study everything that's inside in the educational part of the CME group website, you understand a lot of stuff about market mechanics. It's a free, very big source of information. So, market by price versus market by order. So this is just two different types of data feed. Market by price is simply giving you the first 10 price levels with the total contracts in the bid and the total in the asks. Market by order instead is telling you for all price levels what's exactly the amount of different orders in every part of the book. This is the so-called level 3 data. And so you can see every single pack, every single order by itself when they're executed. This is thanks to the so-called order ID. And let's see if I can find it, but I'm not sure. But fuck it. Every order has an ID, okay? So for example, I could place one order for 2 contracts. And let's say this order ID is 3701. Okay. And then maybe I'll place another order for 1 contract. And that will have another order ID, which could be 3702, sorry. Then another guy might come in. Let's make it a different color. He might place a 5 contracts order, and that will be 3801. Okay. 01 is my first order, 02 is my first order, 37 is the ID that identifies me as an operator, and 38 is the other guy. So every aggressor or every, let's say, passive participants has an ID. You can't know who they are. They're completely anonymous, but you can identify them. If you have the data, you can actually realize if a certain operator is always doing the same thing, for example. And this is crazy because they can, if you're starting to be too big, they start smelling you in the order book. They can kind of identify, they can start identifying you, okay? So imagine you're a big market participant. And native icebergs, which are provided by the exchange, they basically work like this. The iceberg, every little 20 contracts that we've seen here, which is actually 1,000, you know, there's 20, 20, 20, 20. Every one of those 20 is actually the same order with the same order ID, simply being reloaded. With synthetic icebergs instead, every order has a different ID. So it's not the same order which is being reloaded, it's multiple 20 contract orders. So if you're a big market participant, a native iceberg will show your order to the market. Like, people can actually understand by seeing that you have the same order ID, that's okay, this is the same market participant. But if it's a different ID, people will not see it. Is that clear? So with native iceberg, people can see you and can be 100% sure with numbers, with ID, with MBO data that it's you and it's a real iceberg. With synthetic icebergs, they might see it at the end of the day because you can see them in the footprints. There's a huge amounts of orders. Okay, that was an iceberg. I didn't know it. But with native icebergs, we can be sure, thanks to the order ID. Sorry, with the native icebergs, we can be sure with the order ID. With synthetic iceberg, we might not be sure until the very end of the iceberg. So the cool part is, like, now you would say, hey, synthetic icebergs sounds way better. Like, you're anonymous. The thing is, with synthetic iceberg, it's different orders. So you're constantly at the back of the queue. While with the native iceberg, even if there's a queue behind you and you keep reloading, you're actually always at the front of the queue because it's that 20 contracts get consummated and then replaced and replaced, but you're still at the front of the queue. So the native iceberg is better if you want to be sure to get filled. Synthetic iceberg instead, you're less likely to get filled, but you have the advantage of being anonymous for some time. So you have an extra advantage. Is this clear, guys? 8 in the chat. I know we're getting really deep. Should probably take a break or something because we're going really, really deep. So we're talking about market makers. Yeah. Icebergs are always in the book, always market makers. So let's see a practical example. Do you guys know who's Navinder Sarao? If you know Navinder Sarao, please put an N in the chat. If you don't know, please go and watch who he is. He's basically one of the people who was blamed for the 2010 flash crash because he was spoofing like a motherfucker. He was spoofing with the size of JP Morgan, but he was a young Indian trader from his feet-smelling bedroom in his parents' house in Hounslow, London. Like crazy. It's a really interesting story. And here we have one of his colleagues, Miltos Savvidis. These are a London prop firm, Futex, and you can see some example of this. And let's watch it together. Let me just make sure that you guys also hear the sound.
Okay, hello everyone. Welcome to this price ladder analysis. So what we're specifically looking at is going to be a setup in the Euro Stoxx 50 futures. And we're looking at two types of patterns, a spoofer that comes into the market and also someone that comes in and absorbs. Now these are probably working together basically. Either it's one person or someone sees liquidity and then trades off of it accordingly. So what we're going to take a look at in a second, so we're just going to wait until this replay loads up, is the market. Now let's just take a look at the average bid and offers in the market. Right now we've got about 100 up on 61s, about 100 odd on 62, 63, 500 lots. Overall, just a little bit away from the 2 or 3 price range of the market. We've got 1,000 lots just stacked on the offer, 1,000 lots stacked on the bid. So overall, we know our average size is around 1,000 lots, give or take, if you look at the whole depth of the book as it stands at the minute. So let's just see now, as we're trading 62s, we're seeing someone just kind of come into market here trying to sell a little bit at 62s, trying to take it off at 62s. Someone seems to be just sitting, passively on 62s, slightly absorbing whatever's coming to him at the minute. 50 lots trading into him. He's absorbing it. We're seeing a little bit of activity here where the bids and the offers are bulking up.
Let me see if we can find the exact moment. You can jump right back. Yes, here we are. So keep an eye on this level, 2960. And you see there's a bunch of orders here. At the same time, there's huge orders in the lower level. So keep an eye on 2960 and 2959.
Reloading for now, not actually letting it go bid just yet. You can see we just went 50 lots lifted, came down.
Do you see it now? 3,000 contracts. These are scary for the people. And down here in the lower level, so many contracts actually being executed.
Hit the bid for 330 lots. And someone just seems to be now passively sitting in front of these 60s. Now, if you were trading this, just looking at this right now.
Look, 1,498. This is the volume. This is like the volume profile. All these contracts are being executed, and these are still there. And if you see the book, nothing is being executed on that level. It's just 263.
Initially, you could have been trying to front run this guy, but now I'm already starting to think.
Look, first these 2,000 were here at 2960. Now they're a tick above. So he's also trying to stay one tick above the current price just to make sure he doesn't get those contracts filled. He doesn't want to get the fill here. He's trying to get it below here.
Oh, wait. This guy keeps trying to come in at 60s and 61s, and he's effectively not really doing much. He's not getting his fill, and he's not wanting to get his fill effectively. Every time he comes down to these prices, you can see the market gets down to the price, he puts in a really big offer, the market then hits the bid in front of that big offer, and then someone sits there on the bid reloading. So we're seeing a buyer, a passive absorption buyer, buying at 60s and 59s at the minute. Let's just see how this reacts here. Now we're bid 59s. We've just taken the rest of those 10 lots. 600 lots traded into 59s.
Look at this.
Another 1,000.
3,000 contracts.
So we have 1,200 lots, as you can see here. 1,200 lots trading in at 59s.
And still, these 3,000s are above here.
That is what we call absorption. And this, again, now notice the reaction of two different order flow patterns acting together. And usually this is what you see when you get a spoofer. The spoofer comes into the market on the offer, and likely it's the same guy that's spoofing that is absorbing at 59s. He's trying to get a big buying order away. Notice every time we try and take the bid out at 59s, we just keep reloading. We keep adding more and more contracts to 59. We've done so far 3,500 contracts at 59s, and at the price where we're seeing the big offer come in at 60s, we've done barely any volume. So that is already telling us a bit of a story here. Now, the risk on this trade obviously is very little. If anything, 1 or 2 ticks. We don't really want to take much risk on this trade because effectively once this buyer is gone, and he gets rid of his order, if more sellers come in and overwhelm this area, then the trade's gone.
Okay. And as you can see right after, look at where price is now. A couple of minutes later, he's bought 3,700 contracts of Euro stocks, and the price has moved almost 10 ticks. Sorry, almost 10 points. Let's see where we get. Yes, almost 10. This guy made around $300,000 to $400,000 in a matter of minutes. Minutes. Can't be a retail to do stuff like that. Can't be a retail to do stuff like that. Okay. Is it clear how spoofing and absorption works? 8 in the chat. Okay. Now, let me share with you a video. And this is an iceberg I have taken in the S&P 500. The 30th of May, you can go back and see it at 10:41 German time. And as you can see,
Venuti in questo secondo trade, questo è un iceberg.
Just a second, let me just take off the volume. As you can see, I just do it from the footprint. Before showing you the actual trades, let me just open for you just a screenshot, which I think is better. Where is it? Oh, okay. Yeah. So you gotta look here. This is an example of iceberg. This is how you see it on the footprint. You will see that the side of the bid, sorry, the ask, there's way more volume. Look at this candle. 8 contracts, 10 contracts, 11 contracts, 500, 165. Okay. And so you can see it from the footprint very easily without needing a book. You can see the executed contracts on this level. Let me see if I have another example, but probably not. So let me just finish explaining it and tell you how I trade it and how you can start trading it too and kind of backtest it. So the best thing, for example, is to buy market. So you buy market, and if this is the best ask, this is the best bid. You can't really place an order here and try and put yourself in front of the queue, because 90% of the iceberg you see are native. Mostly are native. So if you try to put your order at the best bid, you will most likely stay in the back of the queue and not get filled until this guy got filled. And when this guy got filled, let me tell you, most probably price will spike down and you get a stop loss. So the best thing to do is not to put a limit here, but to buy market. So you buy market here, place a stop 1 tick below or 2 ticks below. Better if it's 2, honestly, because sometimes it can spike down a little bit. So like the spread can go slightly lower. So I would suggest at least 2 ticks down, and you can take 2, 3, 5, 7, 10 ticks above. So it's a very low risk, high reward kind of setup with a decent win rate. So, for example, price will go down, we get some absorption, it comes down again, it can't break, so we're at the same level, we get more absorption in the footprint. Okay, now we know that we can buy market. We can buy market if we see that there's an anomaly. It has to be an anomaly. It has to be a lot of contracts. Has to be an anomaly. That's why the best place to trade these kind of trades is in low liquidity environments. If there's low liquidity, it's more likely that this will hold. If there's a lot of liquidity, if you see icebergs happening during the cash session in the ES, you're gonna get fucked. Okay? They're gonna bust you out because there's so much volume, so much liquidity that icebergs are like candies. Okay, they're breadcrumbs, easily taken away from the market. But in the London session, maybe in the extended trading hours, that's where these patterns are working the best. Patterns, at least in the S&P 500. Then maybe Serge will tell you a little bit more about the other patterns in other markets. But yeah, this is the trade. So we buy market, we place a stop loss below, and we wait for rebounds. Normally, I would trade up to 2 rebouncings. So if it comes back, I'll still go for a couple ticks. But the more we're hitting this, the more likely price at some point will pierce through it and whether continue, and then this is a really good continuation trade because we understand that probably this is just a profit-taking iceberg, or sometimes it may just spike down and then continue, okay? And normally you would see stops being triggered here, and you're going to be a part of that. And when we will explain the stop run, we will also get deep into this. But I'm not sure we're going to do it today, guys, because it's been 1 hour and a half, and I don't want to overload you with information. We've seen already a lot of stuff. So let's just see a couple examples, and then we'll probably do another live sessions where we'll explain how to trade stop runs and how to trade, and then overall intraday footprint patterns and types of auctions. Let's do at least 2 or 3 lessons so that you guys can metabolize and digest the information. Okay, so this is how you would see it. Okay, this is how you would see it, and this is the trade. So I sold 15 contracts S&P, stop 1 tick above, so $300 worth of stop loss, and then 2 targets. I'm not sure if they're both being executed now, but as you can see, I placed a limit actually on 1 tick below the iceberg. And as you can see, you have 45 contracts here, 45 here, 283. When I saw these 283, I realized, and you can simply see it with the footprint because we don't get above this. We don't execute any order above this. So this has to be a rule. Like the rule is we don't get even 1 tick above. There's a block of orders there, which is front-running price now. So when I see that at least 400, 500 order stack in the same price level, see 283, then again 56, then again 75, I sell. Sell market, and the first 10 contracts are already being filled here, a couple of ticks below, and then the second target is maybe, I don't know, 10 ticks below. Okay, the first has been executed. Let's see what happens next. This is sped up, of course. This has been speeded up. And eventually price gets to the target and I get my fill. This is the first example. Let's see some other example. This is an iceberg that went to stop loss. Let's see how it went through. Yeah. So we had some sort of iceberg here. We had absorption also through with the heat map. And yeah, with that heat map, we can also see the iceberg tracker. We have a tracker for icebergs. But as you can see, I sold here and I was stopped out and executed 1 tick above. So what happens when iceberg gets breaking like this? By the way, this was in the New York session. That's why it was a stop loss, as I told you. During the New York session, there's really a lot of volume going on. And as you can see, every candle has 3,000 contracts, 2,000 contracts, 2,000, 2,000, 2,000. So even 1,000 or 2,000 contract iceberg will be like a knife, like a hot knife going through butter, okay? And the thing is, there's going to be some stops here and they will be swept. So they will hit the bid, that will hit the ask very quickly, and you will be executed at the best price because your aggressive orders is in a queue of market orders, and you can get filled and get a slippage on your stop loss. And this is what happened here. Let me see if I can find another example. Stopper, icebergs. Yeah. Yes. Yeah, this was also shown in the community. And with this strategy, I simply passed a prop firm with a pretty good profit factor. It was a profit factor of 2.2 with a 52% win rate and an average risk reward ratio of 1 to 2. And it's purely based on these kind of patterns. Okay. As you can see here also, we have 1,000, 1,000, 1,000, 1,000, and then 3,000. We can see here in the same level, 700 contracts on a single cell of the footprint. Then again, 238. This is where I buy. And probably before there was something else. Let's see. We see 1,800 contracts all in one single cell. And boom. Very easy. Stop above, 3 ticks below. Easy. I can't do it on audio. No, this is only for futures contracts, guys. This is pure scalping for future contracts. Where are you looking for these setups? I look them mostly in the S&P 500, ES, E-mini contract, and in the London session only. Look at this one. Now, you probably don't see it. I think I didn't record this pretty good, but you can see it easily from the color. You can see there's a very green cell here, green cell, and also here, green, 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 green. And also, those parts of the footprint are highlighted in yellow, which is the point of control of the candle. So it's the place where the most volume was traded. And then I have my indicator, which is signaling me, hey, this might be an iceberg. And so I saw the iceberg. I probably didn't I didn't record it at the beginning. And this was a break and test iceberg. So we broke a level and then we tested that level and there was this, which is my favorite type of icebergs because they're more likely to continue if we just broke and test, and to absorb any buying pressure, we put an iceberg. That's a pattern I prefer, has a higher win rate. Oh, here it is. Here we see also the numbers. Let's see if we can get deeper. Yeah, boy. Yes. So I already took a profit here, 7 contracts out of 15. Let's see what happens next. Let's go a little bit quicker. We have the target over here. Not sure we will hit it. And eventually, yes. And then we hit the target. $900. See if I have any other example, but I think that's it. Yeah, guys, I think that's all I have for you. Let me see if I can have, wait, maybe there's another one here. No. How do you determine the profit target? So through time, I've usually placed like a 3-tick take profit as the easy, like most likely target to get hit. But you need to do some back testing because it depends on the asset. So normally I would go for a 3-tick target, and the second target would be whether liquidity level or, for example, a VWAP. Just a second, let me see if I can. I don't think I have it here, but I will upload it for you, or like we can see it next time. I'll make sure to find it. Just check on this other folder. No, I have some other examples, but you get the point. You get the point. If I use it on the PNB shapes, not necessarily. This is like a very short-term pattern, so it's not really a thing. This is another example. See, I had one. Yes. You can also go and like backtest it yourself. Yeah. This is another example. We got 38 contracts here and then 200. You see there's an anomaly here. Anomaly in liquidity, big market participant, big guy. So the first sell would be here. After those 200 and 150, we sell market, this level, boom. We already get 10 ticks, for example. And then we get stopped for 2 ticks, which is okay. Like the net profit is still good, you know? Also, we had a short here on a stop run that I will explain you next time. So you can have some patterns to backtest in the London session. And as we will see, also stop runs are a low liquidity kind of pattern, and that you can start implementing. You can start implementing yourself. So in the next lesson, we're going to check out the stop runs. We're going to check out types of auctions in the footprint, so you can get a very deep understanding of order flow and eventually start to applying it in a practical way. Let me see. Let me know if you like this live session in the Discord, so I know if it makes sense to continue also with the next live sessions. There's a feedback session inside of the Discord, so please leave a feedback there, and eventually I will see you for the next session, probably next week at some point. I will keep you posted in the Discord. Have a great day, everyone, and have a great weekend.